Imagine asking a self-made millionaire one simple question. Where do you keep your money? You expect to hear the name of a large bank. Instead, he smiles and says, just enough to pay next month's bills. At first, it sounds irresponsible, maybe even reckless. After all, banks are supposed to be the safest place for your money. So why would someone with millions of dollars refuse to leave most of it there? Was he hiding something? Did he stop trusting banks? Or had he learned a financial lesson that most people never do? The answer isn't what you think. And by the end of this story, you may never look at your savings account the same way again. Meet David. At 56 years old, he had built and sold 2 successful businesses. He lived comfortably, but not extravagantly. No private jet, no 20-car garage, no mansion sitting on a hill. In fact, if you saw him at the local coffee shop, you'd probably assume he was retired. What made David wealthy wasn't how much he earned. It was how he thought about money. And one habit confused almost everyone who met him. He rarely kept large amounts of cash sitting in the bank. One afternoon, David was having lunch with a longtime friend. As the conversation turned to finances, his friend asked a simple question. So, where do you keep all your money? David laughed. Not where most people think. His friend looked confused. Wait, you don't keep it in the bank? Only enough to cover my monthly expenses. The room went quiet. That answer sounded completely backward. For most people, the more money they have, the more they leave in their savings account. David did the opposite. But before you assume he was taking unnecessary risks, you need to understand how he viewed cash. David believed every dollar should have a job. Some money was meant to pay bills. Some was meant to handle emergencies. And some was meant to grow. The mistake most people make, he believed, was giving every dollar the same job. Years earlier, David had made that exact mistake himself. After selling his first business, he suddenly had more money than he'd ever imagined. Feeling cautious, he parked almost all of it in several bank accounts. He told himself he was being responsible. After all, the money was safe. Or so he thought. A few years later, he reviewed his finances. The account balances looked almost unchanged. At first, that seemed like good news. Then, he compared those balances with something else. The cost of living. Housing prices had climbed. Healthcare had become more expensive. Everyday expenses had quietly increased. That's when David realized something uncomfortable. His money hadn't disappeared, but its purchasing power had. The numbers in his account stayed almost the same, while the value of those dollars slowly declined. Inflation wasn't stealing money he could see. It was reducing what his money could buy. And because it happened gradually, he barely noticed. That realization completely changed the way David thought about wealth. He stopped asking, where is my money safest? Instead, he started asking, what job should each dollar be doing? Some money stayed in the bank because he needed quick access to it, but money he wouldn't need for years. He believed it should be working somewhere else, not because banks were bad, but because cash sitting idle for long periods can lose purchasing power over time, especially when inflation outpaces the interest it earns. That simple shift in thinking became one of the biggest reasons David continued building wealth long after becoming a millionaire. But there was one more lesson, a lesson he learned during a financial crisis that completely changed the way he viewed risk, banks, and investing. And it would become the reason he never looked at a bank account the same way again. Years before David became a millionaire, he made a mistake that almost nobody talks about. It wasn't a bad investment. It wasn't a failed business. It was something that looked completely safe. He left too much money doing nothing. After selling his first company, David felt relieved. For years, every dollar he earned had gone back into growing the business. Now, for the first time, he had real financial security. So he did what many people would do. He deposited the money into several bank accounts and promised himself he'd decide what to do later. A few months became a year. 1 year became 3. The money barely moved. Neither did his financial plan. He told himself he was being careful. In reality, he was simply postponing a decision. Then one evening, David sat down with an old mentor, someone who had quietly built wealth over 40 years. After dinner, the mentor asked one question. "How much cash do you have sitting in the bank?" David smiled. "Most of it." The mentor didn't congratulate him. He simply asked another question. "And what is that money doing for you?" David answered confidently. "It's safe." The mentor nodded. "Yes. But is it working?" That question stayed with David for weeks. He started studying how wealthy families managed money. One thing surprised him. They didn't think of cash as an investment. They thought of it as a tool. They kept enough cash for monthly expenses, emergencies, opportunities. Everything else had a different purpose. Some money was invested in diversified stock funds, some in bonds, some in real estate, some stayed in businesses. Some remained in cash because they knew they'd need it soon. The point wasn't chasing the highest return. The point was giving every dollar a job. David realized something else. Most people ask, "Where can I get the highest return?" Wealthy people often ask, "How much risk am I taking to earn that return?" That difference changes everything, because protecting wealth is just as important as building it. David wasn't trying to beat the market every year. He was trying to avoid making one catastrophic mistake. Then came the financial crisis. Markets fell sharply. News channels showed investors panicking. People rushed to make emotional decisions. Some sold everything. Others refused to look at their accounts. David did something different. He looked at the plan he had built years earlier. His emergency cash was still available. His monthly expenses were covered. His investments were diversified instead of concentrated in one asset. He wasn't happy that markets were falling, but he also wasn't forced to panic. For the first time, he understood something that changed his entire philosophy. Financial security isn't about never facing uncertainty. It's about preparing for uncertainty before it arrives. People often assumed David avoided banks because he didn't trust them. That wasn't true. He trusted banks to do exactly what they were designed to do: protect cash, process payments, provide liquidity. But he didn't expect a savings account to build long-term wealth. That's a different job. To David, asking a bank account to grow wealth over decades was like asking a parked car to win a race. It isn't what it was built for. Banks were one tool in his financial life, not the entire strategy. Whenever someone asked David where he kept his money, they expected a secret investment, a hidden strategy, some exclusive opportunity. Instead, his answer disappointed them. "I don't look for magic investments. I build systems." That answer sounded boring. But boring is often what lasts. Because while everyone else searched for the next big opportunity, David focused on making sure his money had a purpose. Every dollar, every month, every year. And that mindset, not a secret stock or lucky investment, was the real reason he stayed wealthy. A few years later, someone interviewing David asked him a question he'd heard hundreds of times. "If you had to start over with nothing, what's the first thing you'd do?" People expected him to name a stock, or a business, or a piece of real estate. Instead, he smiled and said, "I'd build the same system, not the same investments, the same system, because investments change, markets change, interest rates change. But good financial habits rarely do." David explained that he divided his money into 4 categories. Each one had a different purpose. The first was spending money. This stayed in the bank. Enough to comfortably pay bills, cover automatic payments, and handle everyday expenses. The bank was perfect for this job. It provided safety, convenience, and quick access. The second was an emergency fund. Several months of living expenses stayed in highly liquid, low-risk accounts. Not because he expected disaster every year, but because unexpected events eventually happen to everyone. Having cash available meant he never had to sell long-term investments during difficult times just to cover an emergency. The third category was long-term investments. This was money he didn't expect to need for many years. Instead of leaving it sitting in cash, he invested it in a diversified portfolio designed for long-term growth. Some years it performed well, other years it didn't. But because he wasn't depending on that money for next month's bills, he could afford to stay patient. The fourth category was opportunity money. This was the smallest portion. Cash set aside for unexpected opportunities. Maybe a business, maybe a property, maybe a market correction. The point wasn't predicting the future. The point was being prepared when opportunities appeared. David's system wasn't exciting. It wouldn't make headlines. But over decades, it quietly built and protected his wealth. Then he said something that surprised the interviewer. Most people think becoming wealthy is about making better investments. I think it's mostly about making fewer expensive mistakes. That one sentence explained almost everything. Think about the biggest financial mistakes people make. Putting all their savings into one investment. Keeping no emergency fund. Taking on debt they can't comfortably repay. Making emotional decisions during market swings. Waiting too long to start investing. None of those mistakes happen because people lack intelligence. They happen because people lack a system. David believed systems remove emotion from financial decisions. When the market was rising, his system kept him from becoming overconfident. When the market was falling, his system kept him from panicking. It wasn't perfect. Nothing is. But it gave him something many investors never have. Consistency. Before ending the interview, the reporter asked one final question. So, if someone has $10,000 in the bank right now, what should they do? David thought for a moment, then answered carefully. Don't copy what a millionaire does. Understand why they do it. If all your money is needed for rent, groceries, and emergencies, keeping it in the bank may be exactly the right decision. If you're building long-term wealth, you may eventually decide that some money has a different job. The goal isn't to avoid banks. The goal is to understand the purpose of each dollar you own. That perspective changes everything. So why does this millionaire refuse to keep most of his money in the bank? Not because banks are unsafe, not because he believes cash is useless, and not because he found a secret investment. He simply understands that different financial goals require different tools. Banks are excellent for protecting money you'll need soon. Long-term investing is designed for money you won't need for years. Confusing those two purposes can quietly cost more than most people realize. If there's one lesson from David's story, it's this. Don't ask, where should I keep my money? Ask, what job do I want this money to do? When every dollar has a purpose, financial decisions become clearer. You stop chasing every trend. You stop reacting to every headline. And you start building wealth with intention instead of emotion. That's exactly what David did. And while it may not sound exciting, it's one of the biggest reasons he became, and remained, a millionaire. Thank you for watching. If you enjoyed this story and want more real-world finance documentaries that simplify complex money lessons, subscribe to the channel. The best financial decisions often begin with understanding how money really works, not with chasing the next big trend.